Hi, I'm Lim Say Boon, Chief Investment Strategist, CGS-CIMB Securities. The global bear market will likely get worse. Japan and Europe are likely already in undeclared recessions. The US will suffer a deep economic contraction in the second quarter and possibly a recession if there is no resolution to COVID-19 by the middle of this year. Our technical analysis team is forecasting further falls to 1,500 points for the S&P 500. That is about 35% lower than where we are today and 55% down from its recent peak. Economically, what we are going through will likely be worse for the world than the global financial crisis. This is a sudden shutdown of the economy that has exposed vulnerabilities in the global economy. The first vulnerability is that both stocks and bonds were overvalued to begin with. The second vulnerability is that economies and corporate earnings were already slowing before COVID-19 arrived. The third vulnerability is that both fiscal and monetary policy have already been spent through repeated interventions since 2009. We have seen massive interest rate cuts around the world, but we are long past the point where interest rate cuts have net positive effects for the economy. Central banks, the Federal Reserve, the ECB, the Bank of Japan, will buy more debt to stabilize the system. But they have already bought so much debt through quantitative easing over the years. Their balance sheet leverage is already so large that even small movements in the value of their assets can make them balance sheet insolvent. Sure, central banks can't be bankrupt because they can print money. But taking on even more debt can undermine the financial stability of the very system they are trying to protect. Governments can spend a lot of money too, and they will, in their attempts to boost the economy. But cutting interest rates and handing out cash won't solve the problem of the demand shutdown caused by COVID-19. So brace yourself, this will likely get worse. But what can you do? Well, that depends on your time frame. If you're a nimble trader, you might want to continue to short the market. If you're a long-term investor with a high conviction portfolio, but can't take the short-term downside, you might want to hedge the beta by buying put options, inverse ETFs, or through CFDs. But if you're in it truly long-term and can turn a blind eye to your mark-to-market risk over the next half year or so, you can buy progressively as value returns. I wish you well in these challenging times. Stay healthy.